What's going on, everyone? In this week's book review, we're going to be talking about the best revenue management book I have found that I use in my business. Welcome back, everyone. So in this week's book review, we're going to be talking about the book Profit First. This book is absolutely phenomenal because it takes the boring topic of accounting. No offense if there's any accountants listening or watching, but this book packages it into like the topic of accounting into a formula that any business owner can follow. In this video, I'm going to be reviewing the book and do a slight deep dive into how I use the principles in this book for my short-term rental business. Now, before I go into this, I want to first talk about what the book talks about. So the book talks about the 5 foundational accounts. The 5 foundational accounts are going to be income, profit, owner's comp, tax, and operational expenses. I add 2 more savings accounts, which is CapEx, capital expenditures for real estate, and then a 6-month reserve. I follow this formula for every one of my cabins. There are other accounts that I have, but I don't want to make this too complicated. This may be backwards to a lot of accounting principles, but this one outline has helped me grow my business by leaps and bounds and not really have to worry about money too much on the accounting side. So let's hop over to my whiteboard and I'll discuss exactly how to set up each one of these accounts. Alrighty, so this might be a little bit difficult to see. I was trying to play with my lighting a little bit, but I have the 7 accounts that I just talked about here. Again, everyone's business is going to be different. And this is just me taking the profit first principles that I just talked about and then how I apply them to my business here. So you have your income account. So these are all separate accounts. 2 savings accounts and then 5, they could be 3 savings accounts too, but 7 accounts, 2 savings accounts, and then 5 checking accounts. And these are just, I have most of these, all these accounts with the same bank. So you have your income account. This is where all of your revenue goes into. So take for instance, like the cabin, our first cabin made close to 100 grand last year. All that money goes into the revenue account, right? And we don't touch that account. From there, we have a profit account. Now this profit account comes before the operational expenses, the taxes, and the owner's comp. This profit account comes before any of the other accounts, which is backwards to what you usually see when you look at accounting structures. You'll have to read the book and it explains why it does that, but it's helped me a lot. Profit is like your bonus at the end of the year. The book recommends starting with 1% of your top line revenue. And then it can go up all the way to 10%. Why I don't set it at 10% in the beginning is I'll talk about that in a second. So you have your profit account at 1%. Your owner's comp is just going to be how much you're paying yourself monthly. When I first started, I didn't pay myself anything. I saved up enough money to be able to have 6 months of reserves. So profit account 1% to start off with. So 100,000. 1% there. Owner's comp, I didn't pay myself anything in the beginning. Then I took 22%. This percentage is gonna be different for everyone, but I took 22% and I put of that number, 100,000 minus 1,000. Didn't pay myself 22% of that. Put it in a tax account. Usually I don't use all of that at the end of the year through like depreciation and different write-offs. This money that sits in the tax account that's sometimes left over, I use it to improve the property. Say like maybe put in a new hot tub or like just maybe put in a new deck or like upgrade the landscaping. After that, you have your operational expenses. This is going to be your mortgage payment, your utilities, paying your cleaning crew, and your inventory for the month or the year. You can see that this number is actually at the bottom. This main expense number is not under the income number, which is different. What this does is it forces you to think outside of the box when it comes to this number. And this is honestly the foundation of the book. Is it talks about how by taking your profit first, your bonus that you take at the end of the year, and putting your expenses at the bottom, you figure out ways to make more money here by affording, and then that causes you to afford these. So here you have your 6-month reserve. This is unique to what I do. I found that most lenders that you're going to be talking to, whether it be commercial or residential, are going to require at least a 6-month reserve if you want to do future projects. 6-month reserve being 6 months of principal, interest, taxes, and insurance, your mortgage payment, 6 months of utilities, cleaning crew, not 6 months, because if nobody's staying in your property, you wouldn't be cleaning it. And then not maybe half of your inventory, maybe just say 6 months. So you have 6 months principal and interest, 6 months of utilities, and then 6 months of inventory. That's what goes into this reserve account. You don't take anything above 1% here. The book says you want to be able to get to 10%, but you do not take more than 1% profit at the end of the year until this number is fully funded at 6 months reserve. If you want to do more, you can do 8 months. I wouldn't do anything less than 6 months, and this just sits in an account. And then here you have your capital expenditures. Bigger Pockets has a really cool article that you can look up. You can just type in on Google how to calculate capital expenditures. For us being they're relatively newer properties, and we hold our properties for 10 years roughly, this number is just a flat, we figured out is we put about $250 a month away for capital expenditures, anything that may break in the property. So this is the model I use currently for each one of my properties. This is the model I sort of show to my investors outside of the profit thing, but this is how I run my side of the business. My investors get paid whatever I promise them, and then this is how I split up my finances for the properties I either own outright or my half of the income that comes in between the joint ventures I have with my partner. So I hope this has sort of cleared up a little bit of how to do revenue management for your business, for your short-term rental business. If you have any questions or comments, please feel free to leave them in the comment section below. I hope everyone's staying safe, and I'll see everyone on next week's video. Thanks.